Dear friends, welcome to Price Action with Prashant. I am Dr. Prashant Parate. Today we are going to discuss very important topic in technical analysis. This is very basic topic and almost anyone who looks at chart has at least read about support and resistance as well as trend lines. There are many aspects to support and resistance. It is simple but still not so simple. Before venturing into support and resistance, first we will discuss basics of charts. Most commonly used chart is candlestick chart. This is common type of chart used worldwide. This chart which you are able to see on your screen is called as candlestick chart. It is made of four things: open price, where first trade took place in that candle. This is open price for this candle. First trade started at this point. Then there is high, low and close. For this candle, open and high are same. In this candle we can see this is open, this is high, this is low and this is close. So this is open, high, low, close. This is called as OHLC candle. As name suggests, high is highest price for the candle, low is lowest price for the candle and close is last traded price for that candle. These candles are called as OHLC candles. There are 8 data points in each candle. Apart from open, high, low, close, there are 4 more things which we can see, and these are candle range. Candle range is top of candle to bottom of candle. Then there is body. Body is from open to close. Then upper wick and lower wick. So these are 4 more data points. Usually people select red and green colors. Red is for down close candle and green is for up close candle with respect to opening price for that candle. There are 2 possibilities. We can select color with respect to previous day's close, or we can select candles with respect to today's open. We can see at this place this candle is showing red color, but actually it is up bar because it is closing at higher price than previous day's close. But here candle is red because close of this candle is lower than open of this candle. You can select whatever way you want, but usually I prefer to select this way for same day with respect to opening of same day. There are lot of things which can be discussed. There are lot of things to be discussed and I can discuss just on candles for 3 hours. There are interpretations for each candle and it is not topic for today's discussion. Then there are bar charts which are also commonly used. These are bar charts. These charts can be used as OHLC charts, which look different but information is same like candle charts. So this is OHLC bar chart. This is open, this is close and high and low. It represents same information. So using this or candlestick chart is similar. You can choose any one of them whatever you like. But I do not use this bar chart. When I want to use bar chart, I use only high, low and close. This is my bar chart which I use. There are only 3 data points: high, low and close. Open is not present in this chart. So there are only 3 data points, whereas in candlestick chart there were 8 data points. And I have removed color also. This is just simple plain black color. This chart I use when I want to look for spring and upthrust. And there are many things which we can look in this kind of chart. I like to use candlestick chart as well as bar chart. One more commonly used chart is line chart. It is chart plotted by making one point every day. It can be open, high, low or close, or it can be average. Most commonly used is close. I do not use this chart at all. Some people use this chart to show big profits on their trading system in circuit stocks. Any system should be tested always in candlestick or bar charts, on daily chart or lower time frames. These show clear moves in price on day-to-day basis. Weekly chart and monthly chart hide circuits easily. If we are not able to see circuits, then what is the problem? Chart looks very nice, but we do not get entry when it is rising and we do not get exit when it is falling. So this chart is not for retail traders. There are many other charts. Here we can see area chart, baseline, Heiken Ashi, Renko, line chart, Kagi chart, point and figure, range. So I use point and figure chart sometimes, but other charts are not useful for me. This is a point and figure chart which is useful to calculate targets based on accumulation or distribution, but I do not use this chart very frequently, and I am not going to discuss other charts. Now let us see candlestick chart and candles. This is candlestick chart. First, we will see how to select an appropriate time frame. Charts are available from 1 second to 1 month. We can select them for 1 month or 1 year as well. Here we can add 12 months and it will become yearly chart. Most of the platforms provide charts with 1 minute time frame up to 1 month time frame. One candle formed is a trading activity and each candle is significant. Each candle has buyer as well as seller, and sometimes buyer dominate, sometimes sellers dominate. In India, markets open at 9:15 am and close at 3:30 pm. This means it is 6 hours and 15 minutes duration for trading, or it is 375 minutes total duration for stocks. For this duration, we can use 1 minute, 3 minute, 5 minute, 15, 25, 75 or 125 minute time frames. 1, 3, 5, 15, 25, 75. Here I have the charts 1 minute, 3 minute, 5 minute, 15, 25, 75 and 125. For intraday, only these time frames are valid for me. These time frames are selected because each candle formed has same time in each candle and all candles are uniform in one day. If we select hourly chart, then last candle is just 15 minutes candle. So I avoid using hourly candles for any analysis in stocks. Have a look at this. If we select 1 hour, then this last candle is starting at 15:15 and it will end at 15:30. This candle is starting at 14:15, ends at 15:15. Let us check 75 minute. See, this is starting at 11:45. This candle is starting at 11:45 and ends at 13, means it is 75. Then next candle ends at 14:15, means 75 minutes, and this candle ends at 15:30, that means 75 minutes. So every candle formed in one day is of 75 minute duration. This is about time frame selection. Now let us see how I select chart out of these time frames. Usually one needs to analyze 3 time frames for analysis. These are called as high time frame, intermediate time frame and lower time frame. Highest time frame I would select for trading purpose is monthly chart. Highest time frame selected suggests usual time taken by trade to achieve target. Higher time frame is for bias identification or direction of trade, to decide area of significance to initiate a trade. Higher time frame rules price action. It is boss. Lower time frame and intermediate time frame have their trends, but these trends reverse in higher time frame significant areas. These areas are known as demand and supply areas of higher time frame. Intermediate time frame is used to find trend and lower time frame is used to take entry. If monthly bias is up and weekly trend is down, One can look for trend reversal trades on weekly and daily chart only in significant areas of monthly chart. However, if monthly trend is up and weekly trend is also up, then there are good chances of getting bullish trades on daily time frame. It is important to trade in direction of main trend. This is how analysis can be done on 3 time frames at one time. This is 15 minutes chart, this is 75 minutes chart, and this is a daily chart. If monthly is chart selected for bias, then intermediate time from monthly chart will be weekly chart and lower time frame to take entry is daily. 1 month has 4 weeks and each week has 4 to 5 trading days. This trade usually gives target in couple of weeks to couple of months. Then lower than this is weekly as higher time frame, daily as intermediate, and I select 75 minutes as lower time frame. There are 5 candles of 75 minutes duration in every daily candle in stock. For assets like commodity, one can select 4 hourly chart instead of 75 minutes. For intraday trading or trade for couple of days, higher time frame is daily chart, intermediate time frame is 75 minutes and lower time frame is 15 minutes. Each 75 minute candle has 5 15-minute candles. So I hope this is clear now. Some people may want to go even lower. For them, combination will be 125 minutes, 25 minutes and 5 minutes, or 75 minute, 15 minute and 3 minute. Lowest possible is 25 minutes, 5 minutes and 1 minute. These are combinations. One rule which I follow is multiply smaller time frame for entry decision by 4 to 6 to get higher time frame. I usually select 5. So when I want to take decision on 1 minute, I check 5 minute time frame and 25 minutes time frame. Sometimes I trade only single time frame without going for multi time frame analysis. Now if we want to select single time frame, I have found out one way which is useful for me. I believe that markets are manipulated and there are targets in minds of manipulators. They keep their control on that asset till that target is achieved. These targets are usually at liquidity areas where they can find good number of traders so that they can exit their large position without big slippage. These liquidity points can be internal range liquidity areas or external range liquidity areas. Different manipulators operate on different time frames and they hold control till someone from higher time frame takes control, or they lose interest in holding control because they have achieved their target. These people manipulate asset in their direction. And how do I check for their control? Usually if manipulator is bullish, they keep buying regularly and they do not let asset to close below low of previous candles. Here I can see manipulator is in control. Once they started moving price higher, candles do not come back till low of previous candle. Here we can see that any candle low is not broken till this point. And at this point they have given away their control and prices went in sideways direction. Once bulls are in control, candles make new highs and they do not break previous candle low. When bears are in control, they keep holding their fort and they do not let candles cross high of previous candle. This is very simple to see and anyone can identify who is in control. We can do this exercise in our Telegram group. We will share charts of stocks which are being manipulated in such way. We have to identify swing high and swing low. There must be some rules to identify proper swing high and swing low. Some people identify swing with 3 candle pattern. Some people like to identify with 5 candle patterns. We have to choose as per asset. Some assets have 3 candle patterns at swing. Some have 5 candle patterns. I use preferably 5 candle pattern. What is this 3 candle and 5 candle pattern? To identify a real swing high, we have to find out highest price among candles where price was moving up. We'll check from this point. Price was moving up and this is highest point in this red candle. Once highest point is identified, we have to find out low of the candle, that is low of this candle which has formed highest high. In 3 candle pattern, there should be one candle below low of this top candle on left side and one candle on right side. This is minimum number. So here we can see this is highest candle, wick of this candle is highest, this is low of this candle. There is at least one candle which is below this candle low on left side and another candle which is below this candle low on right side. With 3 candle pattern, this is high. For 5 candle pattern, we need 2 candles which are lower than this candle and on both sides, on left as well as right. So this is swing high for 3 candle as well as 5 candle pattern. From here we come down and we can see that this is the lowest candle where there are 2 candles on left side and there are 2 candles on right side which have crossed high of this candle. So this is low. Then in this candle we can find there are 2 candles on left, 2 candles on right. So this is also high. So this is high and this is low. Here we can see there are 2 candles which have formed higher high, 2 candles which have crossed on right side as well as on left side. So this is low. So this way we can select high, low. Here if we check, there are 2 candles below this above this high and 2 candles above this high on left as well as right. So this is swing low, this is swing high. This way we can mark points. At this place we can see there are 2 candles on left side, 2 candles on right side. But at this place, can we see 2 candles above this high? No, there is only one candle which has crossed this high. So, and this candle has not gone below this low. This way we can select high, low, high, low. This is 3 candle pattern and 5 candle pattern to identify swing high and swing low. I prefer 5 candle pattern. If this way swing high and swing low is identified properly, then it will be easy to mark support and resistance as well as it will be easy to mark trend lines. We will see this on charts and we will identify some swing highs and swing lows. I hope this is clear on this chart. We can look for swing high, swing low this way. I have not marked all swing high and swing low on this chart. So here we can see there is one swing low. This is one swing low. This is swing high, this is swing low, this is swing low. Is this swing high? This is highest point. Then there are 3 candles below this, 2 candles below this. So we can mark it as a swing high. So this is swing high, this is swing low. So this way we can identify and mark swing high and swing low. Then there are different criteria to decide whether particular swing high is major swing high or minor swing high. Now let's come back to support and resistance. Support and resistance are most discussed topics in groups and they are undoubtedly important. They are barriers for price. Support is a barrier for downside and it does not allow price to fall below it, whereas resistance is a barrier on upside. Support and resistance are not single points, but they are areas of price range. Single point can never be support or resistance, but yes, lowermost point is most important for support and highest point is most important for resistance. But what is more important? More important is how price reaches area of resistance or how it reaches area of support. How has that area formed and is it really good area of support or resistance? This is also equally important. Volume signatures at these points are also important. Many times support is broken and then prices go up again. Many times resistance is broken and then prices fall rapidly. Why does this happen? To understand this, first we need to understand why support and resistance form and how people trade them. Price of any asset cannot go in one direction continuously. Share markets are not zero-sum game. Meaning of zero-sum game is profit of one person is loss of another. So this is true for options trading or futures trading, but this is not true for share markets. Share prices fluctuate every second in active stocks because there are many buyers and sellers present at any time, and they are either trading or investing based on their time frames. Some people may have bought a share at 10 rupees per share and are looking to book profit when it has reached 100 rupees. Some people may be selling it for trading purpose with view of fall in price from 100 to 95 rupees or 90 rupees. Some people may be looking at very long term and wish to hold that stock for lifetime. For them, it may be just an SIP on fixed date. Markets always have buyer and seller in liquid stocks, and trading continues regularly. So let us see how resistance forms. But before understanding how resistance forms, we must understand how prices move. This is very important to understand. To understand whether a support or resistance has formed or not, we need to understand who is in control. And to understand who is in control, we need to know how price increases or decreases. There is one theory known as Dow theory. According to Dow theory, trend is formed when prices move in one direction. For uptrend, it forms higher high and higher low. Here we can see this is low, then it has formed high, this is low, this is higher low than this low, then prices came, then price increased and formed higher high, then formed higher low, again higher high, higher low, higher high. So this is an uptrend. Price action between one high and one low is called as a swing. So from this low to this high, this is one swing. From this low to this high, this is one swing. From this high to this low, this is correction swing. This high to this low, it is correction swing. There were two swing highs, 1, 2. This is third swing high, this is fourth swing high. So this way, from low to high, it is called as a swing. There are terms called as impulse wave and corrective wave. Impulse wave is in direction of trend, whereas corrective wave is opposite wave and is less forceful than impulse wave. We can clearly see that in this chart. From this point to this point, price increased rapidly, and when there was correction, it was very small correction. Then there was impulse on higher side again, and from this low to this high, price increased rapidly, whereas correction was small. Then again there was impulse on upside, but this time correction was for longer time. And then this is last impulse wave where there is some red candle as well, but it is strong up move. After this last up move, there is stronger correction wave. This is larger than any of these three correction waves. This is called as change of behavior. We'll discuss about this later. But this is important phenomenon. Impulse wave is always more forceful than corrective wave. There are many important things which one must understand before actually understanding support and resistance. I will try to cover as much as possible in this session. So here we can see swing high is a resistance. This is swing high, swing low. There is major swing high, minor swing high. Similarly, there are major swing low and minor swing lows. These are also swing highs and swing lows. There is swing low, there is swing high, there is swing low, swing high. Then again swing low here, swing high here. So there are multiple swing lows and swing highs, but we have to identify which is major swing high, which is minor swing high. This we will cover in details at later point of time. But when trend is up, major swing highs are broken, minor swing highs are broken. When trend is down, major swing lows are broken, minor swing lows are broken. Major swing highs are protected and minor swing highs actually good areas for entry point based on principle of upthrust. Here this is a minor swing high and this is an upthrust entry. Trend is already down. So this is minor swing high where swing high was broken but prices fell down. This is a major swing high and price did not cross above this and it continued to fall down. So here trend is continuing down and there is no sign of trend reversal. Here we can see minor swing high has given an entry on short side, but that minor swing high was broken. On other side, here uptrend is starting. This is a reversal pattern accumulation at this point and it caused reversal. After reversal, what happened? This resistance is broken, this resistance is broken, this resistance is broken, this resistance is broken. So when there is uptrend, resistances are broken and supports are not broken. So here this is swing low which can be good support area and it is not broken. Why is this high broken here? Actually it is a trap. They are kind of liquidity hunt phenomenon where small traders are made to exit their positions and then markets continue their direction. So uptrend means support is held and resistance is broken. Downtrend means resistance is held and support is broken. Trend reversal needs to break this sequence. Trend does not reverse immediately. It takes some time to reverse the trend. Chances are high for trend continuation. As we have seen, swing high is a potential resistance and swing low is a potential support. How are these areas traded? These are usually horizontal areas of support and resistance. So we plot lines at these levels. We plot lines at these levels of high and low. So we plot horizontal lines at these levels. Marking these horizontal lines is also very important and one needs to consider an area instead of one single point. This area marking depends on price action in swing high or swing low, which we will try to cover in some time. First, we will see which type of traders are active in these areas of support and resistance. In all areas, buyers and sellers are active. Who dominates depends upon what is the trend. In support areas, buyers are likely to start buying. But if it is downtrend, sellers want to break that support. So who will be active here? This is a support area. Who will be active at this point? Buyers will be active who would like to protect support area. There will be two types of buyers. First will be the one who would want support should not break and take trade above support area. Then there would be other traders who would want support to break and prices should come back above support area. They wait for sellers to fail so that they can buy. So here we can see some buyers have bought here. They took prices higher. Then price again came down and it went below. But here there is some buying pressure and some traders have bought below this. Some traders must have bought above this support area and they took prices higher. So this way there are two types of buyers. Some are buying above support area, some are buying when prices break below support and come back. Some people buy even below support area and they bring the prices higher. So these type of buyers wait for sellers to fail and then they buy. Then at this area sellers will also be active. They will keep selling to break support. Like at this point they started selling from here and they kept selling, broke support and prices went further down. Some sellers jump after lowest support is broken and they trade based on breakdown. When this candle forms, breakdown traders take entry and they start selling here. That is the reason prices continue to fall down. They think that once support is broken, price will keep falling long way and fall will be big. Resistance will be respected and next supports will be broken. Then there are some sellers who will wait for confirmation of breakdown and then they will sell on retracement back to resistance areas. Once support is broken convincingly, it becomes an area of resistance. So once this support is broken, this becomes resistance. We will see example of supports becoming resistance. This is not very good example of that, but there are some traders who wait for support to break, prices to fall down, and then when price retraces, they sell for further down move. So at support areas, there are 4 types of trades possible. One is reversal bullish trade, where people buy asset and expect price rise. Second type is failure of breakdown and then bullish reversal. Third is breakdown and trend continuation on downside, whereas fourth is retracement to support, which has now turned to resistance, and then bearish trade.